Hello, everyone. Thank you for joining this section of our series, Ask the Experts webinar. Today's presentation's on tax considerations for S corporations and M&A transactions. I'm Ryan Gamble, and I lead the tax practice at Riveron. With me today are Gary Betzel, who's the Managing Director in our M&A tax practice. Gary has 20-plus years of experience in both industry and law firms and professional service firms, helping clients, assisting clients with M&A transaction structuring, diligence, in all matters of M&A. In addition to Gary, we have Thomas Dye, who's an experienced senior in our M&A tax practice. Thomas has significant experience in the M&A transactions as well, with a heavy emphasis on S corporations. We appreciate you all taking the time to attend today's webinar. And before I turn it over to Gary and to Thomas, just want to walk through a couple of housekeeping items and reminders. In order to get in credit for the CPE, you have to answer 4 polling questions that we'll ask throughout the presentation today. And as the series title suggests, Ask the Experts, we really encourage participation through the Q&A process, through the technology that you should have available to you through Zoom, to ask questions of the 3 of us, and we'll take the time to answer those. If for some reason you stump us and there's a question that we're unable to answer, we will take that down, get the right answer, and get that back to you following the presentation. There will be a webinar evaluation form and CPE form certificate will be emailed to you following the presentation. And in addition to that, you'll receive the recording of today's webinar, the deck that you see in front of you, and also an opportunity to join future webinars and webcasts. So with those matters out of the way, I will turn it over to Gary to walk us through the first part of the presentation.
Sure. Gary. Thanks, Ryan. Thanks for everyone joining. So we're talking about S corporations today. Ryan, if I go out to the Delaware Secretary of State's website and I want to file articles of incorporation for an S Corp, am I going to find them there?
You're not going to find them there, and they'll probably look at you with a confused look on your face.
Well, they might know. I mean, there might be people that if you're in person, come down and ask for the forms. But the point being, an S Corp is not a legal form of an entity. It's a tax classification or an entity that's made a special tax election. So from an income tax standpoint, there's generally 2 forms of entities. There's corporations, and we'll talk about C and S Corps. S Corps is the focus of this presentation, and partnerships. Partnerships generally do not pay an entity-level income tax. C Corps do pay an entity-level income tax, and S Corps do not. You meet the requirements, you file the S election, all of your income, gain, loss, deductions, et cetera, pass through and are reported on the shareholder's personal income tax return. We did receive a question before the presentation came in about LLCs. How are LLCs different from S Corps? LLCs are unique. There's a lot of flexibility in the tax law about how you treat LLCs. They can be treated as C Corps. They can also be treated as S Corps, as well as partnerships and disregarded entities. So there's a lot of flexibility about LLCs. If you meet the requirements, you can file an election to be treated as an S Corp, you can file an election to be treated as a C Corp, or your default classification is going to be either a partnership if you have more than one owner, or a disregarded entity if you have a single owner. Why do we have the label S Corps? And the reason is because S Corps the rules around S Corps are set forth in what's called subchapter S of the Internal Revenue Code. Regular corporations are referred to as C Corps. Those rules are set forth in subchapter C of the Internal Revenue Code. Okay. So the next slide shows the tax filings received by the U.S. Treasury. The U.S. Treasury on an annual basis reports all of the different types of filings filed for individuals as well as companies. For fiscal year 2018, there were about $5.1 million S Corp forms filed, 4.2 million partnership returns filed, and 1.7 million C Corp returns filed. I found this very interesting. There are more S Corp returns filed than there are partnership returns. Very interesting. There also were about 500,000 Form 2553 files, which are new S Corp elections filed in fiscal year 2018. Presumably there were some revocations, but the U.S. Treasury does not report that separately. Any questions, group, on that? Okay, the next slide. The next slide sets forth the various it sets forth some legal and tax considerations for the three forms of entities we discussed. The S Corps, the C Corps, and the LLC are partnerships. This last column here is partnerships. LLC's tax is partnerships. The important distinction from a tax standpoint: C Corps are subject to double tax. S Corps are not. There's a single layer of tax. The items of gain, loss, deduction, credit, et cetera, flow through. Same for LLCs. I think it's worth noting, Ryan, that on the employment side, owners of S Corps can be employees of the S Corp. They can receive W-2 compensation. Partnerships or LLCs, tax partnerships, they cannot receive W-2 compensation.
Correct.
So.
Hey guys, real quick, from a technical difficulty standpoint, we recognize that the slides aren't catching up. We're working on that. We'll continue to walk through the presentation with the slides that we have here. We apologize for that, and as soon as we're able to get this technology up and working, we'll get caught up. But we'll continue to walk through these questions and then revisit the polling questions at when we get the technology up and running. So Gary, if you want to keep walking through kind of the next section of the presentation.
Okay.
Hey, Gary, I had a quick question.
Sure.
For S Corps and C Corps and with tax reform and the tax rates changing, are you seeing more companies going from S to C than in the past, or are people still electing S?
Yeah, that's interesting. So as you mentioned or alluded to, Thomas, at the end of 2017, the Tax Reform Act lowered the corporate tax rate from 35% to 21%, also lowered the individual rate slightly down to 37%. Companies are considering whether or not to make that S election. I've even seen in the past few months, I did a deal where an S Corp terminated or revoked its election solely because it was more advantageous in their eyes to have a single layer of C Corp tax. They were not distributing dividends out annually, so they viewed it as more advantageous. It is a much closer call than it was previously with the higher rates, but yeah, I am seeing that a good bit more. Okay?
Yep.
So, what is an S Corp? An S Corp is a small business corporation for which you make this election to be treated as an S Corp. I think it's important to note the term small in the definition of a small business corporation doesn't mean that it's small in the value sense. You can have huge S corporations that are worth in excess of $50 billion. I've worked with one. I know that they're very large S corporations out there. So to qualify as a small business corporation, you first have to be a domestic corporation. Two important terms there. Domestic, you can't have a foreign corporation that makes an S election. can't elect into subchapter S if you're a foreign corporation. You also have to be a corporation. Now, again, I noted earlier, LLCs, there's a lot of flexibility. You can elect to be treated as a tax corporation and therefore elect to make an S election. There are certain types of corporations that don't qualify for subchapter S. There are certain types of banks, insurance companies, and other forms of entities that do not qualify. Also, second requirement, you can't have more than 100 allowable shareholders. So there's both a numerical component to that as well as a character of shareholder question. For purposes of the 100 shareholder limit, members of the same family are treated as one shareholder. The permitted shareholders are individuals other than non-resident aliens, certain trusts and estates. So a grantor trust, which is a special type of trust under the tax law that's treated as a disregarded entity, that's owned by a U.S. citizen, that would be a permitted S Corp shareholder. Employee stock ownership plans, or ESOPs, are permitted. And there are other trusts and estates that are permitted. What are some non-permissible shareholders of S Corps? Partnerships or LLCs that are treated as partnerships, those are not permissible shareholders. Corporations, both C and S Corps cannot be shareholders of S Corps. Foreign shareholders, as I mentioned earlier, and then, of course, you've got certain trusts and estates that don't qualify. Also, you may only have one class of stock outstanding. That requirement is looking at only the economic rights associated with the class of stock. So, Thomas, what have you seen in practice? What types of classes of stock that will meet the S corporation requirement, but they've got two classes of stock outstanding, have you seen in your practice?
Yeah, so I've typically seen it where there's voting versus non-voting stock. So in this particular situation, a family owned a company and some outsiders wanted to buy some stock in it, and so the family wanted to keep the voting rights within the family, and so their stock held voting rights, and then the new non-family member shareholders, their stock didn't have any voting rights.
So voting rights is a typical distinction you see where there's two classes, like a Class A common and a Class B common. Economically, the classes are exactly the same. One carries voting, one doesn't carry voting.
Yeah.
Perhaps the historical family members own the voting rights, and they've given shares to the younger generation that don't have voting rights.
That's right.
So
as long as the economics are the same.
Okay. Okay, so once you've met the requirements for a small business corporation, you have to file an S election. That election is made on Form 2553. It's got to be filed with the Service Center. You can make the election retroactive up to 10 months and 15 days retroactively. So if you're looking to file it, say, with an effective date of January 1st, ignoring some leap year issues, you could file that election by March 15th and make it retroactive to January 1st. Word of caution, watch for states that require separate S elections. There are certain states that do not conform to the federal election. Most states do, but some states do not. New York comes to mind as a state that does not conform to the federal election. You have to file a separate state election. Another example is Pennsylvania. So Pennsylvania conforms by default, but they permit you to elect out. So if for whatever reason you want to be treated as a C Corp in Pennsylvania, but an S Corp for federal, you may file a Pennsylvania election out and be treated as a C Corp in Pennsylvania. also need to watch. All the shareholders must sign the consent form. If you're in a community property state, your spouse must sign as well, the shareholder's spouse. So that's something we'll touch on in just a minute, that the Form 2553 must be signed by the shareholders as well as the spouse in community property states. Looks like we may have the technology solved, Ryan. I don't know, perhaps?
We're getting close, I think.
Okay. I'm on slide 13. Yep. Okay. Okay, so if you've made a good election, you qualify, you're not going to file the regular income tax return for a C Corp, which is the 1120. You're going to file the 1120-S. The 1120-S is going to include K-1s, which are they're forms that report the amounts that the shareholders must include on their personal tax return, i.e. the pass-through income. Send those to the shareholders. They report it on their personal income tax return, or if it's a trust, or state on those returns as well. If you've elected out of subchapter S, if you've revoked, you're not permitted to re-elect within 5 years. And I recently came across that. I think we touched on it earlier. I came across a corporation that in 2018, because of the rate change, it elected out. It's important to note, if for whatever reason our rates go back up, we've got an election coming up for corporations, that company is going to be stuck with the C Corp classification for 5 years. Okay, the next slide is a polling question. Are we good to go on polling questions? We're on polling question 3. So, yes, no, maybe?
All right, let's go ahead now.
Okay, I understand polling questions are not working yet either. So let's continue on. Slide 16, please. Yep. Okay, Thomas, do you want to touch on some points in due diligence around S Corps?
Yeah, thanks, Gary. So, S Corporation tax due diligence, this is a list of some of the high priority items that you want to ask for from the target. The first one being the Form 2553, which, as Gary mentioned, is your election to be treated as an S Corporation. And when you receive the form, you want to confirm that all the shareholders sign the form in a timely manner, and this includes, let's say, the shareholders in a community property state. We're going to want the spouse to also sign that election for it to be valid.
Right.
The next item on the list is the IRS acceptance letter, and this is basically just a letter that the IRS will send the company confirming that they received the 2553 and that the S election is valid.
So let me ask you a question around that, Thomas, a couple of questions. In your practice during due diligence, can they typically come up with these two items?
So for the IRS acceptance letter, you can still email, or not email, but you can mail the IRS or call them, and they'll mail you a new acceptance letter. It won't be dated for the original election, but they can still provide you that notice. But for the Form 2553, if you don't have that, I don't think that the IRS will send you a new one. And it's common to not have that, especially if you're, the S Corporation's more than a few years old. It's a piece of paper that you're holding on to in a file cabinet. So it's easy for people to lose those or misplace them.
If you're looking to, say, sell an S Corp, your shareholder looking to sell, or a group of shareholders looking to sell, Thomas, and you're going through a sell-side tax due diligence process, you come across that they can't find the acceptance letter. Is there a process to remedy that, and how long does that normally take?
Yeah, like I said, I think you can call the IRS or mail them, and I've seen them send you the acceptance letter in the mail within a couple days or a week or two. It's not a long, drawn-out process like you would think when dealing with the IRS.
Okay. Thank you.
So another item that you'll want to request from the target is the a schedule of distributions to shareholders. And this is just to confirm that all distributions were made pro rata based on the shareholder ownership. So for the prior 3 years, you'll be able to see that on the K-1 on the tax return. But for years prior to that and to the date of the S election, you'll want to see an Excel file or something from the company showing that their distributions were made pro rata.
So it's good practice during due diligence to request scheduled distributions back to the effective time of the S election.
Yeah, that's right, because the S election could be invalidly terminated at any point in time. Just because the statute's only 3 years, that doesn't mean it can't be terminated prior to that.
And if you have a disproportionate distribution, that's evidence of a second class of stock, is it?
Yeah, that's right. That's right. We'll get into that in the next couple slides.
Okay.
Another item that you want to confirm is does the company have any related party transactions? And if they do, you'll want to confirm that they're at arm's length and or meet certain safe harbor requirements. One of the safe harbor requirements for a loan is that it's evidenced by a written agreement, and that there's an interest rate, it's not convertible into equity, and it's held by an individual.
And what are the issues around related party transactions? What are we looking for when we look at those items during due diligence? Does it affect your S election, your status as an S election?
Yeah, so if you have a loan between from the shareholder to the S Corp, and it doesn't meet the safe harbor, then it can be viewed as a disproportionate distribution, which would be viewed as a second class of stock, which would terminate your S election.
Okay.
Obviously, one of the more important things you want to receive is the Form 1120-S, the federal S Corp return. And you're going to want to read the return for any elections that they've made, any related party transactions disclosed. You can typically see these on the balance sheet on page 5, and also in the white paper detail of the balance sheet. Want to look at their method of accounting, cash versus accrual, shareholder ownership, which can be seen on the K-1, officer compensation, on the Form 1120-E, which is on the federal return, and anything else the return can display that can help you in your diligence. So the next slide, why is tax due diligence important in an S corporation? One of the most important parts is for structuring purposes. So a 338-10 is an election made by both the buyer and the seller to provide the buyer with a step up in the assets of the S corporation, and it treats a stock acquisition as an asset acquisition, but it's only available if the target is a valid S corporation. So that's why this diligence is important, so that you can make that election.
So, and we'll touch on 338H10 elections a little bit later in the presentation around structuring, but what you're saying is that if during due diligence you uncovered that possibly there's been an inadvertent termination of the S election, you will not qualify for a 338H10 election, and therefore you may lose the ability to get a step up if you went that route.
That's correct, but
okay.
There's other structuring ways to still receive a step up if you have an invalid election. An F reorg will obviously permit you with the step up in the tax basis of the assets without a valid S. However, as we will discuss later, it's more complicated with creating entities and structuring aspects. It can be more costly and time consuming.
Right. We'll walk through the steps of an F reorg and the consequences of an F reorg later in the presentation. Thanks.
So another reason the S Corp tax due diligence is important is for successor liability purposes. So there are certain liabilities that the buyer can be held responsible for, specifically employment tax, property tax, abandoned and unclaimed property, and sales and use taxes. There's really no way out of these successor liabilities from the buyer's standpoint, so that's why it's important to look into these. And obviously one of the bigger issues can be if your S election is invalid, the company will be treated as a C corporation on the date of the termination, and therefore any ordinary business income that the shareholders have been receiving for the previous typically 3 years will now be taxable income at the C Corp level at the C Corp rate.
Right. 21% currently, was 35% before 2018.
Right. And if, let's say the company was in a loss position, there'd probably be minimal tax exposure because they'd be in an NOL state.
Right.
Instead of a taxable income.
Right.
Position. So on the next slide, some of the issues that we typically see in diligence is ineligible shareholders. So
yeah, I was going to give an example of a recent deal that I did involving ineligible shareholders. So I did a deal for a company up in Boston. It was a manufacturing company. They had both a virtual data room that I looked through the materials. Everything in there, including the returns, shareholder listings, was suggesting they had eligible shareholders. They were all individuals, mostly family group. Had to go up to the company to view some. They had an on-site. Went up to the company, viewed some of the corporate documents, and lo and behold, when I got into the stock certificates, especially the canceled stock certificates in the shareholder registry, one of the shareholders had transferred his stock to an IRA. And that's not a permissible shareholder, and it blew the S election, and it started the conversation between the buyer and seller's lawyers. Okay, what do we do now? How do we fix this? How do we go forward with this transaction? So that's one example. Ryan, when have you come across ineligible shareholders of S Corps during the course of due diligence? Or Thomas?
Yeah, I was going to say, I know I've seen it. I haven't actually seen it in due diligence, but I saw it in a 382 study where an S Corp was acquired by a partnership, and it busted their S, and they had NOLs, and so we were actually doing 382 work on them and found that the partnership had actually terminated their S election.
Okay, interesting.
Yeah. Another issue that we typically see, like we said before, the IRS not receiving the IRS acceptance letter, but more importantly, the Form 2553 being missing and or not signed by all the shareholders, which, as Gary said before, that would include spouses of the shareholders in those community property states.
Right, so real-time example here. I'm currently doing a deal. Family holds all of the stock of two S Corps. They're both, the family is located in a community property state. They first made the S election on the first company was made prior to a much later formation of this second S corporation. When they filed that first S election, only the shareholders signed. Presumably at some point they received some advice around community property and the fact that their spouses needed to sign. They did sign the second S election for that second S Corp, but there clearly is an issue for that first S election for that. So that's a real-time example for me.
Yeah. And it's like we said earlier, it's pretty typical for a company to be missing the election form.
Right.
I'd say one of the most important issues is the company having a second class of stock. So this can be done through either having an actual second class of stock with different economic rights or through a disproportionate distribution. And that can be through distributions that are not pro rata. And like we said earlier, you can see that on the K1 or the distribution schedule that they'll provide you. You can compare the ordinary income on page 1 to each shareholder's ownership, and compare that to what they recorded on the line 1 of each K1. Those numbers should match up. Another way is to have loans from shareholders that don't meet the safe harbor that we mentioned earlier. So it's got to be evidenced by a written agreement, have an interest rate, not convertible into equity, and also held by an individual. And another way is loans from the S corporations that are not respected as debt. So then you have to look at debt versus equity rules.
So let's pause there for a moment. Just because a instrument is labeled as debt does that mean that the IRS would respect it as debt for all purposes, or do they look more to the substance, let's call it, or the characteristics or features behind the instrument to determine whether it's debt or equity?
Yeah, so I mean, there are obvious rules and safe harbors that the IRS has provided guidance on.
Just in general, they're going to look behind the labels that the parties put on the instrument. The fact that you can call something debt doesn't mean that it's treated as equity for tax purposes.
That's right.
It's just the label.
Yeah.
Okay.
I would say that's probably one of the most common issues that we come across. I mean, let's say that you have a loan from an S corporation to another company that one shareholder of our S corporation has an interest in.
Right.
For, let's say that they're renting their office space from that other company.
Right.
If that's not a valid loan or valid lease agreement, then that could be treated as a disproportionate distribution or a second class of stock.
Right. Okay. I'll give a real-world example of another arrangement that potentially could blow your second class of stock example. So I'm currently doing a deal, involves two S corporations again, owned by the same group of family members. The operating S Corp is in a very litigious business. It's being sued a lot, so there's a lot of concern on the part of the shareholders of removing profits from the business. So they set up a second S Corp, presumably at a lawyer's direction, and entered into this management agreement between the first S Corp and the second S Corp, whereby the second S Corp is performing management services. There's employees in that second S Corp as well. And the management agreement fee that the operating company is paying is solely driven by the amount of net income of the opco. So it's essentially stripping out 100% of the net taxable income of that operating S Corp.
So it's like they're receiving a distribution.
Right. The actual equity outstanding, there's no value in that with this management agreement in place.
Yeah.
There's nothing being distributed on that equity, nor is there any right to it currently, because this management agreement is just removing all the profits. Presumably, a lawyer recommended that this agreement be put into place for, I guess, litigation purposes to remove the profits. But there's a real risk there that agreement's a second class of stock and it's blown their S Corp election.
Did you have any issue around an S Corp owning another S Corp?
Yeah, we'll touch on that in a minute. So an S Corp cannot be a shareholder of another S Corp. It's going to blow the S election for the bottom tier entity, but there is an election available. It's called a Qsub election, and we'll touch on it in the F-reorg structuring slides a little bit later, that permits what was an S Corp that you make the Qsub election, it becomes a disregarded entity, permits one S Corp to own the stock of another, what was an S Corp, but now is a disregarded entity.
Okay. So another issue that we commonly see is shareholder salaries, and you can see what the officer compensation is on the Form 1125E on the tax return. So the issue here is whether the shareholder is receiving a salary. So if they're not receiving a salary, or the salary is too low compared to a similar position at a similar company, then you could have a payroll tax issue, because typically the shareholders want to receive more in distributions than they do in salary to avoid those payroll taxes. And so the IRS could come back and say, no, you shouldn't have received this much in distributions. It actually should have been, 25% or whatever towards your salary. So you owe employment tax on that.
And Thomas, is that issue or matter for the S Corp election being valid, or is that, so if you say the shareholder hasn't been paying themselves a reasonable salary, either no salary at all or something that's deemed to be too small, and the IRS comes in and determines that that's not a reasonable salary, does that cause us to question the validity of the selection, or is that more just a payroll issue?
I mean, I typically see it as a payroll issue, but I could see where, let's say that one shareholder is receiving, no salary and another one's receiving too much salary, or, a right amount of salary, and they take distributions away from one person, it could make them disproportionate to their ownership.
So
I haven't personally seen that.
Kind of a disguised disproportionate distribution labeled as salary?
Yeah.
Yeah.
I haven't seen it before, but I guess it could happen.
Right. And where do you find, is shareholder salary reported on the income tax return? Is it?
Yeah, so it must be reported on the 1125E.
1120E, yeah.
Yeah.
Right. Okay.
And another issue that can be seen in diligence that you want to look out for is built-in gains. So this applies to S corporations that were previously taxed as C corporations. And the S corporation actually sells some of those built-in gain assets within 5 years of the election.
So I guess level set, and a real world example here. So previously I noted that S Corps do not fall an entity level, or do not pay an entity level tax. This built-in gains tax is an exception to that rule. It's a real entity level tax on what they call built-in gains, or at the time the S election was made, and it can apply in other circumstances. At the time the S election was made, that the company was in a built-in gain position, let's call it. Its assets were had appreciated above tax basis, and those assets are sold within 5 years. And by the way, that time period has been changing. It's come down recently, relatively recently. So it sells those built-in gain assets within 5 years. There's a real entity level tax at the S Corp level here. And so I received a real world question around this. So an individual owned all the stock of a C Corp, and he was approached by a buyer that wanted to buy assets to receive a step up. And we'll talk about step ups in the structuring slides. The seller quickly realized that if I sell assets, I've got a C Corp level tax, and then when I distribute out the proceeds, I've got a second layer of tax, i.e. the double taxation. He asked the question, can I just file an S election and sell the assets and have a single layer of tax?
Outsmart the IRS.
Right. So that's why this rule is in here. Among other, there's other ways that it can apply, but that's a real world example.
It's another example. Thomas and I just came across this recent recent deal. We had talked earlier about several states requiring their own S election at the same time as the Fed S election. They don't adopt it. We were in a deal where they had made the S election actually 10 years in advance of the current year, or the year of the potential sale. It was a sell-side deal. Realized that they had operations and they were filing in New York, and had not filed the New York S election, one of the states that require it, until the last couple of years. So New York has adopted the 5-year requirement as well for the built-in gains tax. So for federal purposes, they're outside the window and safe from the big tax. But for state tax purposes, because they hadn't elected and they elected late, they were inside that window. And now if they sell in the next couple of years, they'll have a New York big tax. So trap for the unwary, not only do you need to make sure you make the election at the state level for the states that require a separate election, you need to make sure you make it timely. And because if you don't, not only do you potentially been not paying corporate tax, if you haven't paying corporate tax, you may have walked into a big tax situation as well.
Right, built-in gains tax. That's interesting at the state level. Okay.
Yep.
I think that was it on the tax due diligence side, Gary. Do you want to walk us through some structuring slides?
Okay, so now the fun steps where the money comes into play, so to speak. Slide 21. Okay, so these slides illustrate at a very high level, the consequences of stock sale, asset sale, and then there are two additional structures. So this first slide here, what happens when a buyer purchases the stock of a S Corp? So the seller is going to receive generally long-term capital gain rate on that sale, 20% plus potentially the 3.8% surtax. It's going to minimize some state taxes if certain states don't respect the S election. It could impose an entity level tax if assets were sold. Presumably, we're not going to have that double state tax by selling stock. The FEIN in certain industries, it's very important that the target maintain its FEIN, and that FEIN will stay in a stock sale. But most important for the buyer is not going to receive a step up to the tax basis of the assets, i.e., there's not going to be purchase accounting occurring at the target level. And just provide a little bit of background on the step up. So in most cases, when there is a step up, it's going to be allocated, that there's a methodology you allocate the purchase price among the assets for tax purposes. It could follow the same consequences as book. It will be allocated to, you go down a list of categories. There are 7 categories, starting with cash and the accounts receivable inventory, PP&E, which is an important allocation point from a tax standpoint. And then it falls into identified intangibles and goodwill. Under 197, the intangibles are amortized over 15 years. PP&E, because of the tax reform, you've got the potential for 100% bonus depreciation. So from a buyer standpoint, it's important to get that step up. There's a lot of benefit from the tax shield from both potentially bonus depreciation as well as the 197 15-year amortization of intangibles. Okay, next slide. Next slide. So asset acquisition. So I just illustrated or went through the consequences to the buyer of receiving a step up. From a buyer standpoint, acquiring assets, you're going to remove any issues around an inadvertent termination of the S election. Any historic tax exposures of the target generally are going to stay with the target. They're not going to come over. You buy assets, you're buying them free and clear of federal income tax liabilities in the past. From a seller standpoint, selling assets, generally long-term capital gain, but there are exceptions. We've already mentioned the built-in gains tax, separate entity level tax if you sell assets within that 5 years of making the S election. I touched on it briefly on the previous slide. Certain states will impose an entity level tax on the sale of assets, like let's say a Texas with that that franchise tax. They're going to impose a gross receipts tax on the sale of assets, as well as recapture income. So most assets sold will give rise to a capital gain or capital loss in a loss position. An example of recapture, which is taxed at a higher tax rate than the capital gains rate, usually the ordinary income rate, is PP&E recapture. So if you've taken depreciation on PP&E, there's rules in the code that are going to force the seller, the S Corp, to recapture that depreciation in the form of ordinary income that the shareholder would report at a higher tax rate. So I guess, Ryan, around what is your experience of sellers being compensated if there are higher taxes, or there are higher taxes if he or she owes on a sale of assets versus a sale of stock?
Yeah, I think we're on the asset purchase that you're going to talk next about an opportunity to sell over here, and we typically see that negotiated through purchase price. If the sellers agree to go through the exercise of an asset sale versus a stock sale, from a seller's perspective, you think about it, and from where they're sitting, if an asset sale is going to involve oftentimes a transfer of title, assignment of contract, so there's a significant legal effort that has to take place in order to effectuate an asset transfer, which is costly to the seller. A simple sale of shares is obviously a lot more efficient and less costly from a legal standpoint. So the cost that they incur just on the legal basis
Right.
And then in addition to that, if there's an additional tax that's owed as a result of an asset sale for depreciation or capture or whatnot, they'll typically want to share in the benefit of the step-up that the buyer is receiving through additional depreciation deductions as part of a purchase price, a negotiated grossed-up purchase price.
Right.
So we typically see that. And we often get involved in discussions with the attorneys that are negotiating both parts of that to go through that calculation.
Right. Are those easy calculations generally, or they involve a little bit of math, circular formulas?
Yeah, it's an iterative
Right.
concept, right? Because whatever you give back to the seller in purchase price is additional purchase price, which leads to additional deductions, so it becomes an iterative calculation.
And so have you seen sellers that have been able to get grossed up for the benefit to the buyer?
Absolutely.
Okay.
Through purchase price, yeah.
Okay.
And generally that it's, between 0 and 50%, called 1 and 50% of the benefit they get, sharing with the buyer. But that's all part of negotiation. There's nothing related to tax that's necessarily important there. It's just a negotiation to the purchase price.
Okay. Okay, next slide. So 338H10 elections, we touched on that briefly earlier, but 338H10 elections are the best of both worlds. It is informed what legally is a stock sale, but what from a tax fiction standpoint is treated as an asset sale. So both the seller and the buyers must join in the election. The seller is typically going to receive long-term capital gain, with those exceptions noted previously, recapture income, maybe there's some differences on the state level, possibly built-in gains tax. The buyer's going to receive the step up. The EIN, again, of the target is going to stay the same. It's just a stock sale. To make the 330H10 election, it has to be a qualified stock purchase. So you must acquire, there's a definition to that, you must acquire at least 80% of the voting value of the target. If there's projected to be rollover greater than that, it's not going to be a qualified stock purchase. You cannot make a 338H10 election. And that diagram on the right there at the bottom shows the tax fiction. The diagram on the left is a legal transaction. It's treated as a sale of assets between what we call a new T corporation or a new S Corp. What will potentially become a C corporation, but a new co is buying the assets. All the historic tax attributes of the old company presumably stay behind. Okay. So now the fund transaction, the F reorg. Again, we mentioned earlier, if you got concerns that your S election is long, you can't make this 338H10 election. You're not going to get the step up. You may get historic tax exposures of the target coming over. That's where there's the F reorg, which is, it's a great transaction. It's a little bit more complicated. The shareholders are going to receive long-term capital gains, except for it's going to be treated like a 338H10 election with an asset sale, but it doesn't carry the risks, essentially, of a blown S election. You can have greater than 20% rollover. You're going to maintain the pass-through structure following the sale. So let's walk through those steps real quickly. So here are the steps generally, and 4 matters. So the seller is going to set up a new S Corp, let's call it NewCo, and contribute all the stock of the old S Corp to NewCo in exchange for equity. Then the seller is going to file what's called a Qsub election, and we briefly mentioned this earlier. An S Corp can't hold the stock of another S Corp without terminating that lower tier S Corp's election. This Qsub election causes the old election, the T in this diagram, to be liquidated. It's treated as a disregarded entity. So prior to step 1, you had S owning a single S Corp with assets and liabilities inside, and following these 2 steps, you have S owning an S Corp with the same assets and liabilities. That is what we call an F reorg. It qualifies as an F reorg under the Section 368 of the Internal Revenue Code. That's tax-free. And then following that, step 3, T is going to convert from a corporation for legal purposes to an LLC, and it's important for this step to occur to give pass-through treatment following the sale. So step 4, by the way, step 3 is a tax. Nothing an LLC is disregarded, much like Qsub. Step 4, buyer's going to come in and purchase the assets of T. He's going to get a step up for the piece he acquires via purchase. The rollover piece is not going to be stepped up. And then the concluding result is it's pass-through treatment for all parties. Everybody's happy. Historic tax exposures of the S Corp stay behind, presumably, if it was a blown S election. Pass-through treatment for both the buyer and the seller going forward. So that concludes the presentation. Ryan, do you think we can get the polling questions working?
We're going to try. Just as we shift to that and try our hand of technology again, in your experience, on a percentage basis, what percentage of your S Corp transactions are structured into an F reorg deal?
A lot of them are, especially if you've got a rollover. It's just much better from both sides. You want that pass-through treatment. If you've got private equity buying the S Corp and they desire a flow-through structure, it's a must. You have to do the F reorg to maintain the flow-through structure following the transaction. So I think they're out there. Are they in most of them? I don't know. It varies. It just depends. So I've seen some traditional 338 elections, and some the buyer wants a C Corp following the acquisition. So it's a mixed bag.
Good. Well, I think we've got the polling questions. It reverted back to the first polling questions. We'll do an end of the presentation quiz to see how well people retain the information we've shared.
Okay, so first question, an S Corp is generally taxed at the entity level for federal income tax purposes, true or false?
So,
Give them some time to think about that.
all right, looks like we've slowed down. I'm going to end polling on that one and share results. So Gary, looks like we got about 80% retained, or remembered what you said about the pass-through entity level of that?
Right, built-in gains tax is an example where there is an entity level tax, but that's generally the exception rather than the rule.
Right. Okay. And then, let's see, we'll go to polling question number, not 3, 2. All right.
Belongs to the polling question. Okay, which one of the following is not a valid S corporation shareholder? Individual that's a U.S. citizen, a grantor trust owned by a U.S. citizen, a partnership or an LLC taxed as a partnership, or an employee stock ownership plan, an ESOP.
Okay, give that a second. All right, looks like we're slowing down now. We'll share those, and here are the results.
So the correct answer is a partnership, or an LLC tax as a partnership. An ESOP can own S Corp stock, and it's a very convenient way, an ESOP is, and a very tax efficient way to hold S Corp stock.
And then I guess the only comment I would have on this one, Gary, is the grantor trust. You can have a defective grantor trust.
Correct.
Right? A trust in and of itself doesn't meet certain qualifications.
Correct.
That could disqualify it, which then has the implication disqualifying your S Corp election.
So, right, so as a matter of convenience, whenever I am doing a transaction, doing due diligence, and the target has a grantor trust as an shareholder, I'm going to request the trust instruments just to look to see if it qualifies as a grantor trust.
Yeah, so don't take it as a matter of faith. They got grantor on the top of the trust document, then in itself,
Right.
you can rely upon the title.
Correct.
So polling question 3.
Okay.
Um,
So an S Corp, or a presumed S Corp is allowed to have multiple classes of stock outstanding as long as the economic rights of the classes are the same. True or false?
Okay, looks like we've got everybody's responded and polling.
Share the results. Okay, so the correct answer is, and looks like 70% of the people got it right, true.
Okay.
Can have different voting rights, but the economic rights need to be the same.
And we come across, like, you hear that a lot. There's a bit of a misnomer where we have two different voting classes. You have, a 50/50 or a shareholder group. One has a golden share, if you will, voting rights for whatever reasons, legal reasons. As long as they're sharing the economics correctly, that golden share doesn't invalidate the shareholder. And then finally,
So, can a presumed S Corp undertake an F reorg with an invalid S Corp election? Can you have an F reorg if it's not an S Corp? I think this is a little bit of a trick question that we kind of didn't cover in the presentation. And the answer is?
so we'll give people just another minute. Looks like we're about.
Ryan,
Almost 50-50.
Ryan, what's the answer on this one?
So no, right.
Yeah, you can do an F reorg even though you're not an S Corp. C Corps can undergo an F reorg.
Correct.
Yeah.
Correct. All right, well, we're about out of time, everyone. Sorry again for the technical difficulties. I'm going to check our questions here, see if we have any questions come through in the last couple of minutes.
Will you receive a copy of the slides? The answer is yes.
Yes, yes.
There will be a separate email distributed with presenters' contact information as well as copies of the slides. We can see the entity types now. Yep. That was a technology problem. Okay.
All right, everyone. Again, thank you for your time today, and I apologize for the technical difficulties, but we hope you found the information presented valuable. And if you have any questions, feel free. Our contact information will be in the slides. Feel free to shoot a question to Gary or Thomas or myself, and we'll reply as soon as we can. With that, we'll turn you back over to your day, and hope you have a good rest of the week. Take care.
Thank you.